The global economy is built on an illusion of endless growth. Yet history repeatedly shows that every debt cycle ends in turbulence. Countries borrow as if money is infinite, but compounding obligations quietly set the stage for collapse. In 1929, the United States faced an unprecedented banking crisis. Yet few recognized the warning signs in rising debt to GDP ratios. Banks had expanded credit aggressively, fueling speculative bubbles that masked underlying economic fragility. Economic collapses follow patterns that are remarkably consistent across centuries and continents. Debt accumulation, excessive credit, and monetary policy missteps create a chain reaction that policymakers often ignore until it's too late. Sovereign debt acts like a slow-burning fuse, invisible until it ignites financial panic. Once governments can no longer service their obligations, inflation and currency stress follow almost inevitably. In the early 18th century, the South Sea Company in Britain collapsed after debt levels exceeded 200% of projected national revenue. Investors lost fortunes, and the government had to intervene with emergency measures to stabilize confidence in public finances. These cycles are not anomalies, but structural phenomena, repeating across eras from Amsterdam in the 1600s to Argentina in the 2000s. Human behavior, regulatory gaps, and overconfidence in monetary tools create predictable instability. The mechanism behind collapse begins with credit expansion beyond productive capacity. Banks lend aggressively, governments borrow freely, and households spend beyond sustainable incomes, creating a fragile financial web. When too much debt accumulates, monetary authorities often respond by printing money to service obligations. Inflation erodes purchasing power, while temporarily masking fiscal imbalance, delaying inevitable correction. Historical data from Germany in the 1920s shows hyperinflation can destroy a nation's savings in months. By November 1923, the Reichsmark had lost 99.99% of its value, illustrating the extreme endpoint of monetary mismanagement. The South Sea Bubble, Tulip Mania, and Mississippi Bubble all demonstrate how speculative fervor compounds systemic vulnerability. Each crisis began with optimism and ended with catastrophic wealth destruction once leverage reached critical levels. Debt to GDP ratios provide a measurable warning signal, yet policymakers often misinterpret temporary growth as sustainable stability. Japan's 1980s asset bubble inflated GDP illusions while debt quietly mounted, ultimately leading to a lost decade of stagnation. Banking regulations have historically lagged behind financial innovation, creating recurring vulnerabilities. The Glass-Steagall Act of 1933 was a reactive measure, implemented only after catastrophic bank failures revealed systemic weaknesses. Sovereign borrowing often masks real fiscal imbalance, creating an illusion of stability. Greece's crisis in 2009 exposed decades of hidden debt, misreported budgets, and reliance on borrowed funds to finance recurrent deficits. Currency collapses frequently follow mismanaged debt cycles. The Argentine peso lost 75% of its value between 2018 and 2019 as debt servicing obligations became unsustainable, triggering capital flight and social unrest. The modern financial system magnifies these risks through interconnectedness. A collapse in one country can trigger contagion across borders via banking exposure, trade, and reserve currency dependencies. Historically, central banks have acted as both stabilizers and accelerators. The Federal Reserve's loose monetary policy in the 1920s fueled stock market speculation, and while later interventions attempted to curb the fallout after the crash. Financial crises often reveal hidden leverage in non-bank sectors. In 2007, mortgage-backed securities and derivatives created off-balance sheet exposures that magnified the U.S. housing bubble's collapse into a global recession. Inflation acts as both a symptom and a response in debt crises. Governments inflate currencies to ease debt burdens, but unchecked, this erodes savings, destabilizes commerce, and undermines confidence in institutions. During the Latin American debt crisis of the 1980s, Mexico and Brazil faced interest rates exceeding 15% amid stagnant GDP growth. Servicing debt consumed national budgets, leading to austerity measures and social upheaval. Policy decisions often follow political cycles rather than economic prudence. Short-term fixes, such as quantitative easing or stimulus packages, can defer collapse while deepening long-term vulnerabilities. Historical collapses reveal a paradox. Financial innovation intended to stabilize economies often accelerates instability. Complex instruments and exotic derivatives spread risk invisibly until shocks trigger cascading failures. The 1997 Asian financial crisis illustrates how fixed exchange rates and speculative capital flows can create sudden collapse. Thailand's baht devaluation led to regional contagion, wiping out trillions in asset value across Southeast Asia. Debt crises frequently coincide with geopolitical stress. Wars, trade disputes, and sanctions can strain already fragile fiscal systems, accelerating inflation and devaluations. Credit booms and busts follow a psychological cycle of confidence and fear. Overconfidence inflates asset prices. while panic triggers rapid deleveraging, often far more violently than the initial buildup. Historical data shows that early warning indicators often exist but are ignored. Rising private sector debt, widening trade deficits, and asset price inflation repeatedly preceded major financial collapses. Government interventions can mitigate immediate pain but rarely solve structural imbalances. Bailouts, subsidies, and interest rate adjustments may stabilize markets temporarily while leaving underlying debt problems unresolved. The pattern of boom and bust is remarkably similar across centuries. London's 1720 South Sea crisis mirrors modern credit bubbles, emphasizing that human behavior drives financial instability more than technology or policy. Monetary policy failures often stem from misunderstanding liquidity versus solvency crises. Central banks may inject liquidity into insolvent systems, providing temporary relief but ultimately delaying necessary restructuring. Historical collapse illustrates that currency strength is fragile. The Dutch guilder in the early 1600s lost significant value when speculative tulip investment overstretched private credit systems, requiring government intervention to restore confidence. Modern parallels emerge in countries running persistent trade deficits funded by external borrowing. The US and European economies rely on reserve currency demand, but rising debt ratios could stress global liquidity in the next downturn. Inflationary pressures today mirror historical crises. Asset prices, energy costs, and credit expansions create a feedback loop where rising nominal values mask real economic fragility. The European sovereign debt crisis of 2010-2012 highlights structural vulnerability in currency unions. Member states shared monetary policy but maintained independent fiscal responsibility, exposing debt imbalances and triggering bailouts. Banking crises often coincide with political miscalculation. Argentina's 2001 default exemplified how populist policy can exacerbate structural debt problems, resulting in mass unemployment and social unrest. The interplay between private debt and sovereign obligations creates hidden risk. When banks hold excessive government bonds, a default can cascade into systemic collapse, as seen in Iceland during 2008. Historical examples reveal that external shocks accelerate inevitable corrections. Oil price spikes, wars, and pandemics act as triggers, turning latent fragility into immediate crises. The 1920s German inflation was fueled by reparations payments, central bank money printing, and political instability. By November 1923, a loaf of bread cost 200 billion marks, demonstrating how policy missteps amplify debt stress. The United States savings and loan crisis in the 1980s shows how deregulation can exacerbate vulnerability. Insolvent institutions leveraged deposit insurance to take excessive risks, ultimately requiring federal rescue. Modern debt sustainability depends on investor confidence. When that confidence erodes, even highly developed economies can face rapid capital flight, currency devaluation, and rising interest rates. Reserve currency transitions often occur after periods of fiscal excess. The shift from the British pound to the US dollar as the dominant global reserve reflects centuries of accumulated debt and financial mismanagement. Credit cycles are amplified by speculative instruments and leverage. Derivatives, swaps, and securitization create hidden exposure that only becomes visible during economic stress. Historical collapses show that inflation, debt, and currency crises are interlinked. Governments cannot solve one problem without affecting the others, creating a web of financial consequences. The 2008 global financial crisis illustrates the danger of interconnectedness. Problems in subprime mortgages propagated through international banks, causing global recession and trillions in lost wealth. Sovereign defaults often result from a combination of structural debt, weak growth, and external shocks. Mexico in 1982 and Russia in 1998 demonstrate how fiscal imbalance intersects with external pressures to trigger crises. Economic patterns repeat because human psychology is consistent. Overconfidence, greed, and herd behavior drive cycles of debt accumulation, speculation, and collapse. Debt restructuring has historically been a double-edged sword. While it provides relief, it often undermines investor trust and can lead to prolonged economic stagnation. The Latin American debt crises of the 1980s caused decades of lost growth. Structural reforms and IMF interventions alleviated immediate fiscal stress, but long-term development was hindered. Banking regulations frequently evolve reactively. Basel I, II, and III frameworks were implemented only after systemic failures highlighted the insufficiency of prior rules. Inflation and currency devaluation historically correlate with sovereign overborrowing. Zimbabwe in the 2000s and Germany in the 1920s exemplify how unchecked fiscal expansion leads to hyperinflation. Modern monetary policy risks mirror historical patterns. Quantitative easing, low interest rates, and massive balance sheets create hidden fragility that could accelerate the next collapse. The interplay of fiscal stimulus and debt sustainability is delicate. Excessive stimulus during growth cycles often leads to debt accumulation and inflationary pressures and subsequent downturns. Financial collapses are rarely sudden. They are preceded by measurable indicators. Rising leverage, asset bubbles, and widening fiscal deficits are early warning signs frequently ignored. Global debt has surged in recent decades, surpassing 350% of global GDP. This level of indebtedness mirrors periods preceding historical crises, raising concerns about systemic vulnerability. The modern US dollar's reserve status provides temporary global stability. However, rising US debt levels could undermine long-term confidence in the currency, triggering shifts in global financial flows. Historical patterns suggest that economic crises are inevitable, not exceptional. The frequency may be mitigated, but the underlying structural vulnerabilities remain persistent. Speculative booms often disguise systemic weakness until a trigger exposes hidden fragility. Investors' optimism creates feedback loops that amplify debt and risk exposure. Monetary tightening can reveal hidden insolvencies. When interest rates rise, overleveraged institutions and sovereigns may default, triggering cascading financial instability. The 1994 Mexican peso crisis shows how sudden devaluation can cascade through emerging markets. Contagion affected Brazil, Argentina, and beyond, emphasizing global interconnectedness in debt crises. Government borrowing often substitutes for private investment during crises. While necessary for stabilization, excessive dependence on debt can constrain future growth and fiscal flexibility. Historical collapses reveal a paradox. Interventions prevent immediate disaster, but often increase long-term fragility. Each bailout or stimulus creates moral hazard, incentivizing repeated risk-taking. Currency collapses erode public trust in institutions. When inflation accelerates or exchange rates collapse, citizens lose faith in the government's ability to manage economic fundamentals. Debt accumulation is often invisible until it becomes unsustainable. Misreported budgets, off-balance sheet obligations, and financial engineering conceal true fiscal risk. Modern parallels to historical crises are evident in emerging markets with high foreign-denominated debt. Currency depreciation can make obligations unsustainable, triggering defaults and social unrest. Financial literacy and transparency are critical to systemic resilience. Countries that accurately report debt and implement prudent regulations are better positioned to avoid collapse. The pattern of boom and bust transcends geography and ideology. From Amsterdam to Argentina, the underlying mechanisms remain consistent, illustrating structural vulnerabilities inherent in debt-based economies. Economic collapses are not caused by single events, but by chains of cause and effect. Debt, monetary mismanagement, political decisions, and human behavior converge to create systemic crises. The historical record shows that no economy is immune. Even the largest and most developed nations have experienced severe financial crises when debt and leverage become unsustainable. Understanding these patterns allows for informed analysis of contemporary risks. Investors, policymakers, and citizens can recognize early warning signs and implement strategies to mitigate systemic exposure. In conclusion, economic collapse is often hidden, gradual, and predictable when patterns are studied carefully. The lesson from history is clear. Debt, leverage, and monetary mismanagement always carry consequences, even if invisible in the short term.